Hello dear students, I welcome you all to today's lecture on share capital. The objectives of this lecture are to understand the meaning of share capital, to understand the various types of shares, to understand the meaning of alteration of shares, to understand the concept of forfeiture of shares, to understand the concept of surrender of shares. The joint stock company is a big form of business organization. The amount required by the company for its business activities is raised by the issue of shares. The amount so raised is called the share capital or capital of the company. It may be noted that a company limited by shares will have share capital. A company limited by guarantee or an unlimited company may not have share capital. The persons who buy the shares of a company are called shareholders. Share capital is not the necessary condition of incorporation, although greater number of companies are registered with it than without it. In case share capital is thought necessary, the memorandum must state the amount of capital with which the company is desired to be registered and the number of shares into which it is to be divided. The meaning of share capital was explained by the High Court of Kerala in SNDP Yogam Quilon Re. An application was presented under section 397 against Yogam, and the question was whether the company was with or without share capital. According to the memorandum, the liability of the members was limited. Each member was required to take at least one share, but no authorized capital was mentioned. The court quoted from the Buckley on the Companies Acts and from Palmer's Company Law to find support for the proposition that the words capital and share capital are synonymous. For a company to have share capital, it is necessary that its memorandum should state the amount and its division. Thus, share capital is different from membership fee, even if the payment is symbolized by the issue of a share. Now, we shall discuss the types of share capital. The first is authorized or registered or nominal share capital. This is the amount of capital with which the company intends to get itself registered. This is the amount of share capital which a company is authorized to issue. Nominal capital is divided into shares of a fixed amount. It must be set out in the Memorandum of Association. It can be increased or decreased by following the prescribed procedure. Now, issued share capital. It is that part of the nominal capital which is actually issued by the company for public subscription. A company need not issue the entire authorized capital at once. It goes on raising the capital as and when the need for additional funds is felt. The difference between the nominal and the issued capital is known as unissued capital, which can be issued to the public at a later date. Where the whole of the authorized capital is offered to the public, the authorized and the issued capital will be the same. Issued capital cannot be more than the authorized capital. Issued capital includes the shares allotted to the public, vendors, signatories to the Memorandum of Association, etc. Now we shall discuss unissued share capital. The part of the authorized capital not offered for subscription to the public is known as unissued share capital. Such capital can be offered to the public on a later date. Now we shall discuss subscribed capital. It is that amount of the nominal value of shares which have actually been taken up by the public. It is that part of the nominal capital which has been actually taken up by the shareholders who have agreed to give consideration in kind or in cash for shares issued to them. Where the shares issued for subscription are wholly subscribed for, issued share capital would mean the same thing as subscribed share capital. That part of issued share capital which is not subscribed by the public is called unsubscribed capital. Subscribed capital cannot be more than the issued capital. Let us take an example. A company was incorporated with a share capital of 9 lakh rupees, which was divided into 90,000 equity shares of rupees 10 each. It issued 70,000 shares to the public. The public subscribed for In example number A, 50,000 shares, example number B, 70,000 shares, and example number C, 75,000 shares. Apart from the above, 5,000 shares are issued to the vendor as fully paid. Now the question is, what will be the amount of different capitals? Now let us look at the solution, the authorized share capital. Since the company is incorporated, that is registered, with a capital of rupees 9 lakh divided into shares of rupees 10 each. Therefore, the authorized share capital is rupees 9 lakh, that is 90,000 shares of rupees 10 each. Now, unsubscribed share capital. In this case, it will be the difference between the shares issued to the public and the shares subscribed by the public. This difference in example number A is rupees 2 lakh, that is rupees 7 lakh minus rupees 5 lakh. This is the unsubscribed share capital. In example number B, the public has subscribed for 70,000 shares of rupees 10 each. Therefore, the subscribed share capital is rupees 7 lakh. Since the subscribed share capital is equivalent to the issued share capital, therefore, there is no unsubscribed share capital. In example number C, the public has subscribed for 75,000 shares of rupees 10 each. It is important to note that the subscribed capital cannot be more than the issued capital. Hence, the subscribed capital in this case will be equivalent to the issued share capital of rupees 7 lakh. There is no unsubscribed capital in this case. Now we understand what is meant by called up share capital. The amount due on the shares subscribed may be collected from the shareholders in installments at different intervals. Called up share capital is that amount of the nominal value of shares subscribed for which the company has asked its shareholders to pay by means of calls or otherwise. If 10,000 shares of rupees 100 each have been subscribed by the public and the company has asked the shareholders to pay rupees 10 on application, rupees 20 on the allotment and rupees 30 on the first call, then the called up capital of the company would be rupees 6 lakh, that is 10,000 into 60. The remaining amount, that is rupees 40 per share on 10,000 shares, that is rupees 4 lakh, would be the uncalled capital of the company. Now we understand what is meant by paid up share capital. That part of the called up capital which is actually paid up by the members is known as paid up share capital. In other words, paid up share capital represents the total payments made by the shareholders to the company in response to the calls made by the company. Paid up capital of the company is calculated by deducting the calls in arrears from the called up capital. That is, paid up capital is equal to called up capital less calls in arrears. For example, in the above situation, out of the 10,000 shares of rupees 100 each, on which rupees 60 has been called by the company from the shareholders, one shareholder holding 100 shares fails to pay the first call of rupees 30 per share on his shares. The paid up capital of the company would be rupees 6 lakh minus rupees 3,000, that is rupees 5 lakh 97,000. Now we understand what is meant by reserve share capital. It is that part of the uncalled capital which has been reserved by the company by passing a special resolution to be called only in the event of its liquidation. This capital cannot be called up during the existence of the company. It would be available only in the event of liquidation as an additional security to the creditors of the company. Now we understand what are the different types of shares. The various types of shares are: number 1, equity shares, number 2, preference shares. Both public and private companies are continued to be permitted equity shares with differential rights. Differential shares can be with respect to dividend, voting or otherwise only if certain conditions are fulfilled. These are: number 1, authorization by the Articles of Association and shareholders by means of a special resolution. Number 2, up to 25% of the total post-issue paid up equity share capital, including equity shares with differential rights, are issued at any point of time. Number 3, track record of 10% dividend payment in the last 3 immediate last financial years. Number 4, no default in filing accounts and annual returns in immediate 5 last financial years. Next, no default in payment of dividend, debentures, deposit, preference shares, loans from banks, financial institutions, statutory dues of employees, principal and dividend, interest, dividend both. There should be no default under the SEBI, SCRA, FEMA and RBI Act. Detailed disclosures in explanatory statement. Disclosures in board reports. Types of preference shares. The first is cumulative preference shares. In case the company has not been able to pay part or all of the annual dividends because of insufficient profit, the unpaid amount is carried forward to the future years and made good when the company has sufficient profit to pay the dividends. These type of shares are called cumulative preference shares. Non-cumulative preference shares. Non-cumulative preference shares are those type of preference shares which have a right to get a fixed rate of dividend out of the profits of the current year only. They do not carry the right to receive arrears of dividends. Next is participating preference shares or non-participating preference shares. Those preference shares which have a right to participate in any surplus profit of the company after paying the equity shareholders in addition to the fixed rate of their dividend are called participating preference shares. Those preference shares which do not carry the right of share in excess profits are known as non-participating preference shares. Next is convertible preference shares or non-convertible preference shares. Those preference shares which can be converted into equity shares at the option of the holders after a fixed period according to the terms and conditions of their issue are known as convertible preference shares. Preference shares which are not convertible into equity shares are known as non-convertible preference shares. The next category is redeemable preference shares or irredeemable preference shares. Redeemable preference shares are those preference shares that the company will buy back at an agreed date in the future. Irredeemable preference shares are those that will not be bought back by the company. Shareholders will continue to earn dividends as long as profit is earned. Now, the tenure of preference shares. The amendment of 1988 has abolished the category of irredeemable preference shares. Section 55, Clause 1 says that no company limited by shares shall issue any preference share which is irredeemable after 20 years. Companies have been permitted to issue preference share for a period exceeding 20 years for infrastructural projects. Now we take a look at the procedure for issue of shares. The procedure is number 1, issue of prospectus. Whenever the shares are to be issued to the public, the company must issue a prospectus. The prospectus means an open invitation to the public to take up the shares of a company. Thus, a private company need not issue a prospectus. Even a public company issuing its shares privately need not issue a prospectus. However, it is required to file a statement in lieu of prospectus with the Registrar of Companies. The prospectus contains relevant information like names of directors, terms of issue, etc. It also states the opening date of the subscription list, the amount payable on application, on allotment and the earliest closing date of the subscription list. Next is application of shares. A person intending to subscribe to the share capital of a company has to submit an application for shares in the prescribed form to the company along with the application money before the last date of the subscription mentioned in the prospectus. Now, what will happen if there is an oversubscription? If the number of shares applied for is more than the number of shares offered to the public, then that is called as oversubscription. Undersubscription. If the number of shares applied for is less than the number of shares offered to the public, then it is called as undersubscription. Next, we discuss allotment of shares. After the last date of the receipt of applications is over, the directors proceed with the allotment work. However, a company cannot allot the shares unless the minimum subscription amount mentioned in the prospectus is collected within a stipulated date. The directors pass a resolution in the board meeting for the allotment of shares, indicating clearly the class and number of shares allotted with the distinctive numbers. Then, letters of allotment are sent to the concerned applicants. Letters of regret are sent to those who are not allotted any share, and the application money is refunded to them. Partial allotment. In partial allotment, the company rejects some applications totally, refunds their application money, and allots the share to the remaining applicants. Pro rata allotment. When a company makes a pro rata allotment, it allots shares to all the applicants but allots lesser shares than applied. For example, if a person has applied for 300 shares, he may get only 200 shares. Next, we understand what is meant by call on shares. The remaining amount of shares may be collected in installments as laid down in the prospectus. Such installments are called call on shares. They may be termed as allotment amount, first call, second call, etc. Next, we discuss calls in arrears. Some shareholders may not pay the money due from them. The outstanding amounts are transferred to an account called as calls in arrears account. The balance of calls in arrears account is deducted from the called up capital in the balance sheet. Next, we understand what is meant by calls in advance. According to the Companies Act, a company may, if so authorized by its articles, accept from a shareholder either the whole or part of the amount remaining unpaid on any shares held by them as calls in advance. No dividend is paid on such calls in advance. However, interest has to be paid on such calls in advance. Terms of issue of shares. A limited company may issue the shares on the following different terms. Number 1. Issue of shares for consideration other than cash or for cash or on capitalization of reserves. Number 2. Issue of shares at par, that is, at the face value or at the nominal value. Next, issue of shares at a premium, that is more than the face value. Next, issue of shares at a discount, that is at less than the face value. Now we understand what is meant by issue of shares at a premium. When the shares are issued at a price higher than the nominal value of the shares, then it is called as shares issued at a premium. The amount of premium is decided by the board of directors as per the guidelines issued by the SEBI. Such share premium collected by the company is credited to a separate account called as Securities Premium Reserve Account. Although the securities premium account is a profit to the company, it is not a revenue profit. It is treated as capital profit, which can be utilized only for the following purposes as provided in the Companies Act. Number 1. Issue of fully paid bonus shares to the existing shareholders. Number 2. Writing off the preliminary expenses of the company. Number 3. Writing of the expenses of issue or the commission paid or the discount allowed on any issue of shares / debentures. Number 4. Providing the premium payable on redemption of preference shares or debentures. The company can utilize the security premium for any other purpose only on obtaining the sanction of the courts. Now we understand the issue of shares at a discount. Under the Companies Act 1956, issue of shares at a discount was permitted, subject to certain conditions provided in Section 79. However, Section 53 of the Companies Act 2013 provides that no company can issue shares at a discount. Under the Companies Act 2013, only sweat equity shares can be issued at a discount. This brings us to an important question as to what is meant by the sweat equity shares. The issue of sweat equity shares is governed by the provisions of Section 53 of the Companies Act 2013. Sweat equity shares mean equity shares issued by the company to the employees or directors at a discount or for consideration other than cash for providing know-how or making available rights in the nature of intellectual property rights or value additions by whatever name called. It is therefore necessary for the issue of sweat equity shares that the concerned employee either provides the know-how, intellectual property rights or other value additions to the company. Now that brings us to forfeiture of shares. Sometimes some shareholders fail to pay the called up amount in full, that is, they do not pay in one or more installments after the allotment of the shares to them. In such a case, either the company can go to the court and file a suit against the defaulting shareholders for recovery of the due amount or can cancel the membership of the defaulting shareholders. In case the membership is cancelled, the amount paid by the defaulting members towards the share capital stands forfeited. This is called forfeiture of shares. Now, the reissue of forfeited shares. If the shares are forfeited, the membership of the shareholder stands cancelled and the shares become the property of the company. Thereafter, the company has an option of selling such forfeited shares. The sale of forfeited shares is called reissue of shares. That brings us now to the surrender of shares. A shareholder who is not able to pay the call money may surrender his or her shares to the company. The company cancels such surrendered shares. Surrender is a voluntary act on the part of the shareholder, whereas forfeiture is a compulsory act on the part of the company. The effect of both surrender and forfeiture is the same, that is, cancellation of the shares. The company can accept surrender of the shares if permitted by its articles of association. The accounting treatment in respect of surrender of shares is the same as that of forfeiture of shares. Now we come to the alteration of share capital as provided in section 61 of the Companies Act 2013. A limited company with a share capital can alter the capital clause of its memorandum of association in any of the following ways, provided authority to alter is given by the articles of association. Number 1. It may increase its capital by issuing new shares. Number 2. It may consolidate the whole or any part of its share capital into shares of large amount. Number 3. It can convert shares into stock or vice versa. Number 4. It can subdivide the whole or any part of its share capital into shares of smaller amount. Number 5. It can cancel those shares which have not been taken up and reduce its capital accordingly. Any of the above things can be done by the company by passing a resolution at a general meeting, but do not require to be confirmed by the National Company Law Tribunal. Within 30 days of alteration, notice must be given to the Registrar of Companies, who will record the same and make necessary alteration to the company's memorandum and articles. Notice to the registrar has similarly to be given when redeemable preference shares have to be redeemed. Similar information is also required to be sent where the capital has been increased beyond the authorized limit or where a company, being not limited by shares, has increased the number of its members. Now we understand further issue of share capital under section 62 of the Companies Act 2013. A company, including a private company, having a share capital can increase its subscribed capital by issue of further shares to persons who are holders of equity shares of the company in proportion to the paid up share capital on those shares by sending a letter of offer. This is known as shareholders' preemptive right or rights issue. The following conditions must be fulfilled when an offer of shares is made to existing shareholders. Now we understand the conditions which have to be fulfilled in case of shareholders' preemptive right or rights issue. The first condition is the offer shall be made by notice specifying the number of shares offered and limiting a time not less than 15 days and not exceeding 30 days from the date of the offer within which the offer, if not accepted, shall be deemed to have been declined. Number 2. The notice shall be dispatched through registered post or speed post or through electronic mode to all the existing shareholders at least 3 days before the opening of the issue. Number 3. The offer shall be deemed to include a right exercisable by the person concerned to renounce the rights offered to him or any of them in favour of any other person, and the letter of offer shall contain a statement of this right. Number 4. After the expiry of the time specified in the letter of offer or on the receipt of earlier intimation from the person to whom such notice is given that he declines to accept the shares offered, the board of directors may dispose them of in such manner which is not disadvantageous to the shareholders and to the company. It is important to remember that these conditions shall not apply to the increase of the subscribed capital of a company caused by the exercise of an option as a term attached to the debentures issued or loan raised by the company to convert such debentures or loans into shares in the company. The terms of issue of such debentures or loan containing such an option have been approved before the issue of such debentures or the raising of the loan by a special resolution by the company in its general meeting. Now we come to shareholders' preemptive rights and the arena of judicial control. The inherent right of the existing shareholders to the new shares of the company has extensive judicial backing in India and other jurisdictions as well. In India, the Companies Act has always found mention regarding the preemptive right of the existing shareholders to the new shares of the company. The Companies Act 1956 had explicit mention relating to the preemptive right of the existing shareholders. The Supreme Court, while dealing with this provision in the landmark case of Nana Lal Zaveri versus Bombay Life Assurance Company, laid down that the company must give the first option to the existing shareholders before favouring anyone else. The Companies Act 2013 also explicitly provides for a preemptive right of the shareholders to the new shares of the company. The Supreme Court also recently in the landmark case of Sahara India Real Estate Corporation versus SEBI held that Section 81 postulates that a preemptive right on the part of the existing shareholders to the new issue of shares. Thus, it is evident that a company which engages in the further issue of shares should offer it to its existing shareholders before favouring anyone else. This is a recognized principle in India as well as in other jurisdictions around the world. Besides offering shares to its existing shareholders, a company having a share capital may issue further shares to the employees under a scheme of employee stock option, subject to special resolution passed by the company and subject to such conditions as prescribed under Rule 12 of the company's Share Capital and Debenture Rules 2014. Now let us understand what is meant by employee stock options. According to Section 2, Clause 37 of the Companies Act 2013, employee stock option means the option given to the directors, officers or employees of a company or of its holding company or subsidiary company or companies, if any, which gives such directors, officers or employees the benefit or the right to purchase or to subscribe for the shares of a company at a future date at a predetermined price. A company having share capital may issue further shares to any person if it is authorized by a special resolution either for cash or for consideration other than cash if the price of such shares is determined by the valuation report of a registered valuer subject to such conditions as prescribed under Rule 13 of the company's Share Capital and Debenture Rules 2014. Now we understand what is meant by reduction of share capital. A reduction of share capital is unlawful except when sanctioned by the court. Conservation of capital is one of the main principles of company law. The share capital of a company is the only security on which the creditors rely. Any reduction of capital, therefore, diminishes the fund out of which they are to be paid. It is for this reason that companies limited by shares are not allowed to purchase their own shares, because the capital is thereby reduced. For the same reason, the power to forfeit and to accept a surrender of shares are strictly guarded. But sometimes there may be a genuine necessity for the reduction of share capital. Closely fenced power is therefore given by Section 66 of the Companies Act 2013. Under this section, a company limited by shares or a guarantee company having a share capital may reduce its capital in any way. It may, for example, number 1, extinguish or reduce the liability on any of its shares. Number 2, cancel any paid-up share capital which is lost or is unrepresented by any available assets. Number 3, pay off any paid-up share capital which is in excess of the wants of the company. Complete details of the procedure to be followed for effecting a reduction are given in the Act itself. Authority to reduce the capital must be present in the Articles of Association. In pursuance of that authority, a special resolution must be passed which should authorize the contemplated reduction of the capital. The next stage is to apply by petition to the court for an order confirming the reduction. Now we come to the conclusion. The main function of authorized capital of a company is to protect the existing shareholders against possible dilution of their equity interest by the issuing of shares beyond the stipulated limit. The authority therefore given to the companies to purchase their own shares has given the companies the flexibility to decide on matters directly relating to the share capital of the company. With this, we come to an end of today's lecture. Hope you have understood fully. We shall meet again next time with a different topic. Till then, take care of yourself. Goodbye and stay blessed.